Your money already has impact. The question is whose values it's advancing. Today, I'm going to map out how to align your portfolio with what you believe in using ESG funds, B Corps, and other impact tools without giving up performance. Let's turn values into money.
Yeah. So they might go away today.
What's happening, my beautiful money makers? Welcome back to another episode of the Do Different Better show, where we talk about wealth, wisdom, and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, and CEO of Social Impact Now, Connective Institute, and Managing Director of the Integrated Capital Fund. Thanks for joining me today. So here's my promise to you today. By the end of this episode, you'll one, understand what impact investing actually is, two, know what your options are across public and private markets, and three, leave with a 30, 60, and 90-day action plan to shift your money thoughtfully, measurably, and profitably. Want my one page framework and checklist? Don't forget to subscribe to my YouTube channel, Do Different Better, and grab the episode resources. Okay, y'all, let's first start off with setting the table. When you hear people talk about impact investing or ESG, they either light up or their eyes just kind of glaze over. Today, we're going to keep it plain, practical, and you know me, profitable. So, first, let's really just break everything down. First, let's talk about impact investing in general. Here's sort of my working definition it's really using your money to create positive and measurable social or environmental outcomes with a financial return. This is not charity, it's not wishful thinking, it's investing, but with receipts. Now, let's talk about ESG. That is environmental, social, and governance. And it's really a mechanism by which you can assess risk and looking at it through a specific lens of thinking about your portfolio. So, when we talk about the E, which is environment, in ESG, we're talking about energy usage, emissions, climate exposure, anything around water, anything about around climate change. Those are all things, how things are resourced. Those are what we're talking about for regarding the E in ESG. Then there's the S in ESG. S stands for social. This could be labor practices, how a company it manages their supply chain. Is it equitable? What are the things that they're thinking about? Are they trying to simplify and ease the supply chain? But it's also about product safety, not only for the workers, but also for the end user. Then there's the G. The G stands for governance. That means the board independence, any incentives, and transparency. This can also include the general makeup of the board. So you might have companies that say, hey, we have 50% women on our board. We have um, a lot of diversity in our board, whether that be ability, whether that be age, whether that be gender, or maybe that is sexual orientation. But we're talking about who and how the organization is governed, and that's usually at the board of directors level. So ESG by itself doesn't tell you if a company is good or if a company is bad. It tells you how well it's managing risk that affect the long-term performance of the company. Now, B Corps versus public benefit corporations. So I'm just going to break this down really quickly. And these are all really 7,500 foot views, right? Not 10,000, not 5,000, but somewhere in the middle. So here's some quick clarity. B Corp certification is a third party seal of approval. Think of like a good housekeeping, for those of you who remember good housekeeping, a good housekeeping seal of approval or rubber stamp that yes, this organization has met a certain level of criteria, that these companies are meeting performance and a transparency standard that is set up by the B Corp organization. And I will tell you, as Social Impact Now is a certified B Corp, it is a rigorous process. You have to get a minimum score to qualify for the B Corp seal, which you can publicize. It's a part of your marketing materials, but it is a very rigorous process to go through. It took us probably about 2 or 3 months to go through the process, and we had to hire an intern, a graduate intern specifically, to just manage that process. So do not take that. When you see a B Corp certification, do not take it lightly. That organization had to go through a lot of scrutiny to be able to get that seal. Now let's talk about a public benefit corporation, or PBC. That is an actual legal structure that's recognized by the IRS, right? It outlines that the company's charter bakes a public purpose into its decision making. So you'll see both of them out there. There might be B Corps that are also public benefit corporations. There might be corporations that are B Corp but are not necessarily filed their taxes as public benefit corporations. And again, none of these are all good or all bad. I just want to break down to you the different standards and what each of them means, because B Corp is, again, a sort of stamp of approval by a third party reviewer, whereas a certified public benefit corporation is actually a tax status that is recognized by the IRS, right? So those are the things. And so where how that actually plays out practically is, it is far less likely that a CEO might be fired if in a public benefit corporation, because as it relates to maybe not hitting their profit or revenue goals, because the public benefit corporation, the way it's set up is that social benefit is first, it is primary, so that the company and everybody involved in the decision making at the governance level is willing to sacrifice profits if the social impact is taken care of and is first and foremost, right? So just so you understand what that means and what that looks like. So again, you'll see both of them out there. Some firms are both, some are one or the other, but the key is to know exactly what you're getting connected to or investing in. Now, let's talk about the spectrum of impact. Impact isn't just one product or one way of thinking. It is actually a continuum of a spectrum. You can choose different tools across different accounts and different asset classes. What you do want to do is you can, and here are a couple of lenses by which you can think about this as it relates to your portfolio. One, you can think about it through the context of what things do you want to avoid investing in? Those are called negative screens. Some typical ones that people have leveraged is they don't want to invest in tobacco, they don't want to invest in private prisons. That's one way to look at it. Another framing is actually in making improvements. So with an ESG integration tilt, it tilts towards firms managing risk and quality really well. The aim is to really identify some thematic funds. So it could be clean energy, it could be water, it could be affordable housing, it could be affordable workspaces. Those are all themes which are a group of investments that are working towards a particular theme, right? So, very similar, like I said, affordable housing is a theme, clean water is a theme. And what they're trying to do is actually influence active ownership, proxy voting, shareholder advocacy, and engagement. So, the way that those are done is through private and community capital. This could include CDFIs, or community development financial institutions, revenue based finance, impact private equity or venture capital, and or local co-ops. You do not have to do all five of these. Even one move or one fund switch with one community note starts the alignment of aligning your money with your values. Now, let's start to talk about the myths versus the reality. And I'm going to give it to you straight, no chaser. Okay. So, myth number one that you might hear from your advisor or in the Wall Street, in out in the media, in the Wall Street or the Financial Times, Wall Street Journal, is myth number one is ESG means lower returns. Here's the reality. ESG is just a risk lens. It's not a magic performance button in one direction or the other. As with any investment, results may vary by manager skill, the fees that you pay, and the market cycle, just like any other investing strategy, right? Some ESG funds actually outperform their non ESG funds or investments or portfolio stock options. Some don't. The point is better information, you getting better information about what might be some of the material risk to either the industry that that particular investment is connected to, or as it relates to your own portfolio risk and what you're trying to do and the levers you want to pull and the goals that you have for your portfolio. Myth number 2: impact means concessionary. Another reality check: there is a range. Market rate, plenty. Below market or flexible also exists, often on purpose to catalyze outcomes. Like community lending, that's a big one. You decide where to sit based on your goals, your time horizon, and your liquidity needs, meaning how much cash you might need at any given moment and being able to access cash quickly at any given moment. That's liquidity. Myth number 3: it's all greenwashing. The reality is, greenwashing is actually a real thing. And so are good managers with hard metrics. So, what's your defense? A clear impact thesis, meaning what changes because my dollars showed up? How are the proceeds going to be used? Or you might hear the term use of proceeds, or strategy transparency, and KPIs you can track, such as emissions that were made if you're interested in environment, jobs created or jobs kept, or jobs that had upward mobility, right? Or even access. Who has access to work there, to acquire the products that are being made, all of the things, right? And there's also third party assurances or audited reporting whenever that's possible. There's a thing called the Global Impact Initiative Network. It actually has some benchmarks of right by industry, but I have a whole episode on this. You want to be careful about some of these standard reporting because often they are measuring the largest sized companies. They're not looking at some of your more local companies in your community that might be doing really well. They have multi-million dollars in revenue or sales. They may or may not be publicly traded, but because of their size and scale, they're not necessarily included in some of these benchmarks. So if they were, the benchmark would definitely be moved in one direction or another. If a product or company can't explain its impact in 1 minute and two metrics, that might be a signal to keep it moving. It may not be the thing for you, or you unless you are interested in doing more digging. But again, if a company is saying that they are really focused on impact of any kind, they should be able to outline to you very quickly and very succinctly what they're doing, why it matters, and what is actually the outcome of the things that they do or the work that they do or the company, the impact of the company. So now here's the question: why now? Let's talk about the business case and the sleep at night case, right? So here's the business case: climate risk is financial risk. Human capital and good governance drive resilience in a company. Companies managing these well are often better at the boring things that compound, like cost control, brand trust, and regulatory readiness. Here's the sleep at night case: your money is already having an impact somewhere. The choice is whether it aligns with your values and your long term plan. So, here are quick examples. Let's talk about public markets. You can swap your broad range large cap fund for its ESG sibling to tilt away from the worst governance and environmental risk. Same style box, smoother alignment. You can think about a thematic sleep by adding 5 to 10% of your portfolio into clean energy or water or future of work funds. They're actually called that, future of work funds. By knowing your concentration, risk, and rebalance with new contributions. Another way to approach it is active ownership. That's choosing a manager that publishes how they vote proxies, and I'll talk a little bit more about that, and the engagement outcomes, not just policies. Then there's community. Place a small percentage of your portfolio in community development notes or green social bonds. The income plus measurable outcomes is what you're looking for, right? Then there's the next one, which is guardrails. These are things you want to avoid just so that you can avoid having any sort of buyer's remorse. Thinking about what are the fees and looking at those, making sure that there's no halo effect. Compare expense ratios to the non-ESG peers. Also, look at your holdings. Peek under the hood. Do the top 10 holdings match the story, right? Metrics, or there aren't metrics, then as far as I'm concerned, it didn't happen. Once again, ask for a couple of KPIs and a cadence for updates. When you go to a particular company and you scroll down to the bottom, they'll have a little tiny button that says investor relations. Typically, any questions you have about the portfolio, one, you can download their last investor report. If you want, you can run it through ChatGPT and say, hey, using an ESG lens, what are the top concerns and what are the top advantages of investing in this company? And it's going to spit out some things, right? And if you have questions, you can follow up with their investor relations person whose whole job it is to answer those questions. But next, you want to think about tax and location. So don't blow up gains. Use new cash and tax advantage accounts to phase in changes into your portfolio. And then finally, micro assignment. And so I've kind of talked about, we built up your lineup as far as where are your options. In the next segment, let's grab we're going to grab a statement and list the fund name, the ticker, the expense ratio, and the top 10 holdings. That's it. Okay. We'll use that to pick your first tilt, right? As far as the first fund that you want to think about investing in. If you want the one-page impact menu and the myths versus reality checklist, go ahead and subscribe to my YouTube channel, Do Different Better. The download's also going to be in today's episode resources. So drop a line while you're there so more folks can align their money with their mission. And I will see you after the break.
So they might go right to, hey, yeah. So they might go
Welcome
right.
back to the Do Different Better show. I'm your host, Elaine Rasmussen, and I've just given you the rundown on the 101 of ESG and impact investing. And I asked you to go to your ticker, your favorite website, investing website. Maybe it's Investopedia, maybe it's something else, but I asked you to go do some homework, and that is to go ahead and pick some stock or pick a stock, right? So let's say went and did your homework. So your homework included getting a fund name, a ticker, the expense ratio, and the top 10 holdings. Okay. Now let's turn that into a values aligned lineup without blowing up diversification, taxes, and fees. Another good thing that you might want to think about is just also taking something out of your 401k. So pull out your last statement from your 401k and just pick something from what you're already invested in. That's also a really good way to even think about it because that's something tangible that you're already invested in, right? Or maybe you have an inheritance of a stock. Take that stock and we're going to run through this exercise, okay? So first, let's talk about public markets and some easy on-ramps. So the ESG sibling swap, which is really simple and low friction. Let's take one broad core equity fund and replace it with one of its ESG siblings in the same style box, meaning if you're looking at large cap blend, look for an ESG large cap blend, right? You can even go on the internet and just do a search, right? And let's say, and if you're doing international, make sure you swap it out for international. Because what I'm trying to get you to look at is compare apples to apples and not apples to oranges. You don't want to do a large cap blend international fund and compare it to a large cap domestic fund, right? We want to measure apples to apples to see how this is actually going to play out, right? So this is why this works. It helps you to keep track error and keeping track error low versus your current benchmark. So again, we want to compare apples to apples. This also helps you tilt away from the worst governance and environmental risk. What you'll find is often the price is similar. Maybe it's a little bit higher. So you can look for that. What's the expense ratio? So here's what you can do to be able to think about that. Same region, same market, broadly diversified, lower controversy exposure, fees are in line. Check. Great. Okay. Number two, we're going to look at a thematic sleeve, right? So we're going to you can take that same thing and we're going to look at it from a theme perspective. And you might want to think about how much do you want of your dollars you want to do in your portfolio, or you want to think about it maybe as a percentage. Maybe it's 5, maybe it's 10%. I'd like to use a nice round number as opposed to 1% or 2%. It just makes the math really easy. You just need to move a zero. Move a decimal point, but you do what works for you. So choose one theme that matches your why. Now, in order for this to work, you gotta figure out what your why is, right? So once you figure that out, maybe your why is climate and clean energy, maybe it's renewables, maybe it's grid modernization, maybe it's efficiency, maybe it's water and circular economies, maybe you're focused on infrastructure or waste to value ratio. Maybe you're thinking about health and community well-being, such as like affordable housing, REITs, right? Real estate investment trusts, or access to care or healthcare. There's also inclusive innovation and workforce, human capital, diversity of leadership. Those could be, those are all themes because they're concentrated on a particular outcome, right? So what you might want to think about is keeping your portfolio in sleeves. Those are what they're called, sleeves, right? This is a thematic sleeve. And maybe your impact investing is coordinated as a sleeve versus you doing it across your portfolio. It's also a great way to think about just dipping your toe in the water of like, I'm going to take a percentage of my portfolio and I'm going to invest this percentage. Maybe it's 5, maybe it's 10, maybe it's something else, and I'm going to identify something that I'm going to invest in that's along my values driven theme, right? Another way to think about it is global ex-US and emerging markets, right? So using an ESG integration. So don't forget non-US exposure. And a lot of fund managers like it as a counterbalance to anything that might be happening domestically by hedging the downside of investing domestically with an emerging market that is on its way up. So that is something definitely you can look at and discuss with your portfolio manager if you have one. But definitely looking out for international or emerging market funds that publish country or sector weights, plus ESG methodology in plain English. So what you want is transparent screening, integration rules, stewardship approach on how they vote and engage at the board level, and that holdings are not identical to a plain vanilla peer with just ESG slapped on the label. This is what we're kind of looking for. And then the fourth thing is thinking about cash and safety. Where your values meet liquidity is thinking about your savings and your parking, where you park your cash can also align. So maybe think about short duration, high quality bond funds with ESG integration, right? So you might think about, hey, I have 20% of my portfolio in a fixed income, which typically fixed income has a low rate of return anyways. If you're concerned about that, this might be a place where you can think about leveraging some of your fixed income into like high impact social impact bonds or green bonds or ESG bonds, right? Green social sustainability bonds for a slice of fixed income is actually could be a really good fit for you. For municipal bonds, or sometimes they're called munis, you can ask about what is the use of proceeds so that green isn't just a color. You're actually seeing and understanding that what they say that they're doing, they're actually doing. And this is why a lot of folks like social impact bonds that are pay per performance, right? So meaning that they don't get the money until they've demonstrated some performance, or the performance is benchmarked at every social impact milestone that the organization reaches, they get a payout from the bond. So those are some great options, and those are called social impact bonds that you might want to consider and look at. So now let's do some quick portfolio math. I know for those of you listening, maybe in your car, this is going to be like, Elaine, you're throwing too many numbers. But I will have a sidecar that will go along this, and you can print this out and be able to see this, right? So let's do some quick portfolio math. Let's say you have core equity or traditional or an ESG sibling, and that is 60 to 80% of equities, right? You have a thematic sleeve that could be 5 to 10% of your portfolio, right? You could have international or emerging market ESG, your usual allocation target, but ESG is actually integrated into that. And then there's fixed income, meaning that you're keeping the duration and the quality appropriate, but you're adding a little bit of a slice of social or green or environmental to this portfolio. So now let's talk about active ownership and making your shares actually speak for your values, right? Impact isn't only what you buy, it's what you do with what you own. So, there are three questions to ask before you invest with your manager or creating your plan. There's three opportunities. The first is proxy voting policy. Whose policy do you use, and can we choose an impact aligned option, right? You want to look at their voting record. Here's a question you can ask. Show me last year's actual votes on climate risk, human rights, and board diversity. So remember, you can ask these questions of the stocks or funds that you're already in, no matter whether they're ESG or not. But if you're looking to align and have ESG or values-based investments, you can just make this a staple question that you ask every opportunity for every investment option, or you can ask your portfolio manager. They may or may not have these questions. They might need to go to the investors relations department of the funds that you're invested in. But believe me, there is somebody somewhere who can answer that question for you, and as it relates to the investment company or the company that you've invested in. So here are some of the engagement outcomes. You can say, give me three outcomes, policy changes, disclosure, or board shifts driven by your engagement. If they can't answer in 2 minutes, that's data. Then there's private and community capital. So could be place-based and based in the real economy that you see every day. So, for listeners who want tangible community outcomes, this is your lane. It's still discipline, but it's also still diversified. So, you've heard me talk about community development, financial institutions, and community notes. These are great for your fixed income class. They're slow, regular money rate of returns, right? They lend to small businesses, they lend to affordable housing projects, and they often lend to health clinics, right? Usually, this again comes out of your fixed income class because it's a slow, steady turtle, right? It's going to keep going, keep going, keep going, keep going, and regularly produce, right? It's not going to be your stock market, you know, 12, 15% rate of return, right? But they're slow and steady wins the race. These are things that you want to do over the long haul, especially when the younger you are. This is something that will produce exponentially over long periods of time, because not only is it going to continue to add, but you'll have compounded interest on top of it as well. So usually fixed income is a stated term. It has a clear impact report. So you want to check the quality of the credit and the track record and the use of proceeds in these particular instances. And you can ask that of the investors relations department. Once again, scroll down to the organization. They typically will have an investor relations or somebody whose job it is to answer those kinds of questions, right? It might be their communications team, but often it's particularly if they're publicly traded, they're going to have an investor. Somebody's job who is in investor relations is to talk to anybody and who has investor related questions. So number two, let's talk about revenue-based finance, or RBF, and impact private equity and venture capital. Now, these investments are illiquid, meaning you can't just take your money out whenever you want. a lot of times these have a long time horizon of like 7 to 10 years, and maybe even longer, depending on if the company reinvests in some of the companies that are in its portfolio. But first, let's talk about RBF, or revenue based financing. Investors receive a certain percentage of the revenue until a cap is met. This is really useful for values aligned growth companies without big exits. Then there's impact PE or VC. These are mission driven funds. They expect long lockups and vintage diversification. So they might have 10 companies in their portfolio. No company in that portfolio does the same kind of work or may even be in the same industry, right? That's because they're trying to hedge any losses that might be or impact from one particular company in one particular industry. They can lessen the volatility or the damage that might be caused if something happens within that company. All the other 9 companies are in very different industries, different sectors, etc. So number 3 is really investing direct and local. And this is where co-ops come in, public benefit corporations, or B Corps. Now, only if you understand the business model, the founder, and the terms is really important. If you do not, this is not a good option for you. And what you can do is ask for the financials, ask about the governance structure, ask about the cap table, meaning all the people who have invested to date in that company and how much they own and what is due to them based on the agreements that were made at the time of the investment. And you also want to understand what is the clear use of proceeds. So whatever you're putting in, whether it's 5,000, 500,000, you want to know, what are you going to spend the money on, right? So set a cap on illiquid or local exposures within your overall investment policy statement. So remember, your investment policy statement is what is the thesis that's going to drive how you make your investments, right? So, position sizing rule of thumb: illiquid or private in community, right? Make it small, intentional slice that won't derail your plan. And if it underperforms or takes longer to pay back. Now, as we kind of slide in here, we're going to talk about greenwashing and some guardrails. So, here's a 4-point sniff test. One, the thesis. What changes because my dollars showed up? Right? So you once again understanding the use of proceeds, and does the portfolio match the story? Then there's KPIs. Asking them, give me 2 metrics that you'll report on. This could be um, their intensity versus their benchmark. What are the units of affordable housing and how will they be financed? Then there's the fees. Impact does not give you a hall pass. Compare the expense ratios to their non-ESG peers. If they're within a certain, plus or minus, don't quibble about that, right? Just understand that sometimes there is a little higher expense ratio with some of these because there's more work that has to be engaged to give you the quality of impact metrics that you're looking for. And if any of these are fuzzy, I want you to proceed with caution or possibly pass. Definitely run this by your investment manager or your wealth manager if you have one, right? And this leads to the last point, which is talk to your advisor, right? Read this into your next meeting or email. Quote unquote, I want to align a portion of my portfolio with whatever your priorities are: climate, housing, inclusive entrepreneurship, without sacrificing diversification or cost discipline. Please show me ESG sister funds or values based funds in the same style boxes as my current core holdings with expense ratios listed. Identify 1 or 2 thematic options for a 5 to 10% sleeve. Include concentration risk and historical drawdowns. Add a fixed income option with greed or social bonds that maintain my credit interest rate profile. Send your proxy voting policy, last year's actual voting, and 3 engagement outcomes. And if it's a 401k or 401(b) participant, you can add this language. Which impact aligned funds are approved in our plan lineup? What are the fees? And can employees elect a different proxy voting policy? Now, let's say you're doing a DIY, you're doing this on your own, you don't have a wealth advisor. You can use a simple spreadsheet, and the spreadsheet will have these categories, these columns at the top: the fund name, the ticker name, the category, the expense, the top 10, The ESG method, what is the stewardship, and what are the KPIs? I would definitely color code this as red light, yellow light, green light, right? Then there's sequencing. So you want to think about taxes and rebalancing, right? So you want to use your new contributions and dividends to build positions before selling high and gaining legacy holdings. Making changes during a scheduled rebalance window to control drifts and costs. If you must sell, consider tax advantage accounts first, right? Again, talk to your wealth advisor, see and make sure that this aligned with what your actual goals are with your certified financial planner or wealth advisor. Keep your asset allocation intact. Alignment shouldn't wreck your diversification, right? So, as we kind of wrap up this section, I want you to consider picking a core fund to swap out for its ESG sibling and one thematic or community option for a portion a sleeve of your portfolio. And I want you to think about drafting a two-sentence impact policy statement. And it can be as simple as I will avoid X, I will prioritize Y, I will measure KPI 1 and KPI 2 quarterly, right? So, I want to do a quick shout out to our radio partner, AM 950, for backing practical money conversations that move communities forward. Coming up, I'm going to now talk about a 30, 60, 90-day action plan, exact steps, emails to send, and how to track performance and impact without turning your portfolio into a full time job. Stay with me.
Yeah. So they might go right to, hey, yeah. So they might go
Welcome
right
back to the Do Different Better show. In the first segment, I talked about the 101 of impact investing and ESG. And in segment two, really talked about like how you can actually start to think about moving towards ESG by creating at least starting off with a portion of your portfolio and finding what your ESG or impact investing match would be and just tracking it and seeing how it's performing before you actually decide to move your money. Now I'm going to talk about getting down to the nitty gritty, the thing that you actually need to do before you do anything. And the first part is let's clarify your why. And so here is a two-sentence way to start thinking about it, making it really, really, really simple. But it might serve some stuff for you because you might be thinking, oh, I don't even have a clue. And that's okay. The first thing is let's write this down. And that is I'm aligning whatever your value statement is. Once again, could be climate, could be housing, could be entrepreneurship, because why, right? Your risk, your values, your legacy. What is the why that you're doing? And I'm going to measure key performance indicator 1, key performance indicator 2 quarterly. And I'm going to do that for how long? Maybe it's a year. There are 4 quarters in a year. I absolutely recommend you make this a date with yourself. And maybe you do it with your partner. Maybe you do it with a girlfriend. Maybe you do it with one of your kids of like, hey, we're going to do a quarterly review. We're going to have lunch. We're going to have coffee. And we're going to go and we're going to see, did the companies that we were thinking about investing or that we're actually investing in did a thing that they said that they were going to do. Two, you want to get a snapshot of your portfolio, right? So again, you want to create this spreadsheet that has the fund name, the ticker, the expense ratio, the top 10 holdings of that particular fund, and the account location, whether it's in an IRA, a 401k, or if it's at a private stock investment with your wealth advisor. You also want to look at the current asset allocation. So where are you sitting percentage wise? If you have a 401k or 403b, they actually have a pie chart in your statement that tells you what is your asset allocation, how much of it's in large cap, how much is in fixed income, how much is in small cap. They will tell you that. You just need to open it. I don't know about you. When I was young, I never opened up those statements. And then when I started opening them, I looked at them and I didn't know what I was reading. This is some of the things that are in that document. So I definitely encourage you to start working on it. But this can be done on your quarterly financial date with yourself, right? So make one swap or one sleeve, right? So replace one core fund with its ESG sibling. And I'm recommending you do all of this on paper first before you activate it and actually do it. So this is a long game. So you might consider doing this on paper for a year just to see how things track, which will then inform your decisions for the following year. Again, if you have a wealth advisor, you can work on this with your wealth advisor. It's a great exercise, even if you have somebody else doing this for you, so that you are more aware of what actually is going and what's reflected in your portfolio. So you can add one sleeve of like a theme or a community note, or you can actually say, like, I'm taking a particular percentage of my portfolio. The next thing is adding stewardship. So choose a platform or a manager that publishes proxy votes and engagement outcomes. There's a great field one that's called As You Sow. There's a couple other ones that are out there that actually track um, um, voting of different corporations, but particularly the S&P 500. Next, put it on a calendar. Create a recurring Friday 15 minutes to check your contributions, scan the fees, and note any proxy updates. So this doesn't have to be a long involved thing, but I definitely think you should make it a tradition, right? Build some muscle around it. So that's a 30-day move. Let's now talk about 60-day moves, right? Building a structure. So really think about go to your advisor or have a meeting with HR, and you can copy and paste this prompts. I will make it available to you. The subject line is aligning portfolio, ESG siblings, and stewardship. And this is what you put in the email. Hi, my name is, or hi, this is so and so, or hey, HR rep, I want to align my portfolio with my values and my priorities. Here they are, without sacrificing diversification or cost discipline. Please list the ESG sibling funds for my core holdings that are in the same style box and expense ratios and any tracking errors or tracking error notes. Suggest one thematic option, and so we talked about this in the previous segment, so I'm not going to read it all the way through, but you get the idea. So you're going to write this email again. There is somebody's job it is to answer these questions for you regarding your 401k investments, and they get paid a lot of money. They get a percentage of your portfolio, or a percentage that's based on the amount in your portfolio, to never receive any emails like this or questions like this, right? But you want to ask them about the fees, and you want to see if you can ask them about electing for an impact aligned proxy policy, right? And what are your options? Then the next thing you want to do is you want to write your one paragraph impact policy statement. Again, here's an example. I will avoid X. I will prioritize Y. I will review whatever two KPIs each quarter. My impact allocation target is X% with guardrails on fees, diversification, and liquidity. That's just an example. You can come up with your own, and it can be as specific as you want. But I would encourage you to not get too specific, because it can be difficult for you can make it really difficult for yourself to find options. So I wouldn't say I am interested in funds that are investing in sub-Saharan Africa that are helping children 0 to 3 years old. That's a little too specific, but you can say, I would like to invest in funds that have an impact goal of driving prosperity and ending or lessening food poverty in sub-Saharan Africa, right? That might be a theme. Also think about your cash and your income. So think about, where does your money sleep at night? Or is your money sitting at a bank that's actually against your investment policy statement? Also think about community allocation. Once again, CDFIs, thinking about asking them what's the clear use of the proceeds of their work, but size it up so that you can sleep at night. Now, here's what you can do in 90 days. And this is actually going deeper, right? So, one, thinking about private and illiquid, only if this fits your plan. So, thinking about revenue based financing, impact private equity, or investing directly into B Corps. You want to make sure you confirm eligibility, meaning, are you eligible to make an investment in that company? Sometimes they have to have only can do accredited investors. If there are any lockups, if there are any minimums, what are the disclosure and what's the track record of that manager? You also might want to cap your illiquid exposure at a small percentage of your portfolio. Then you want to get into stewardship cycle during the annual meeting season, which is usually the first at the end of the first quarter or at the end of the third quarter, and to listen in or listen to the playback of the shareholders meeting. You'll get to learn a lot about what's happening, but also you want to think about rebalancing without whiplash. So slow and steady wins the race here, right? You don't have to change your portfolio all at once right at this moment, but you also want to think about what are some of the capital gains that might be as a result of you making this shift. And again, you can talk to your accountant or CPA, but particularly they may not be a tax strategist. So if you know a tax strategist, you might want to, they have a different perspective than just a general accountant or CPA. Next, you want to make sure that you're actually tracking performance. And this is where a spreadsheet comes in. And it could be as simple as holdings with the ticker, the expense ratio, and the returns versus the benchmark, the KPI 1 and your KPI 2, and any particular notes that you might have, right? So I know that was a lot, but you really want to go into this with eyes wide open, especially if you are new to this, right? So here are some my final calls to action for you. Okay. Um, and know that you're not in this alone. I actually have an event coming up here December 14th called the Do Different Better Live. You see it um, in the ticker and below. And so we're actually going to go into this a little bit deeper, and you're going to actually work on your 30, 60, and 90-day plan on figuring out what moves you want to make first as far as realigning your portfolio to your values or including an ESG cap. So but you definitely want to think about all of the implications that may come to you. And we'll be talking about those in detail on December 14th at the Do Different Better live event. You can check that out at www.dodifferentbetter.com. So my final call to action. If this has helped, I hope you decide to follow me on Instagram at Do Better with Elaine, and comment impact, and I'll DM you with some great one pagers around creating a strategy for you, a 30, 60, 90-day plan, some glossary of these terms and how you might want to start thinking about this, aligning your money with your values. But I want to once again give big love to our radio partner, AM 950, for amplifying wealth, wisdom, and money moves. So it's not just about making money, it's about making your money move. So I'm Elaine Rasmussen, your host. You've been listening to the Do Different Better show, and I can't wait to do different better with you next time.